how one investor quietly turned $500K into over $1 million in just 1 year.
Welcome to Stock Symbol Selects, where we decode market moves, one symbol at a time.
As of June 27, 2025, a disciplined Canadian investor saw the total assets of his High Five portfolio surpass $1 million. This experiment started with an initial capital of $500,000, followed by a monthly contribution of $10,000. Through consistent application of dollar cost averaging and buy-the-dip strategies, this investor quietly doubled his money in just 1 year. Unlike traditional buy-and-hold investing, this strategy was more of a structured savings system, leveraging the historical average return of the U.S. stock market, which hovers around 10% annually. The twist? Each investment was made strategically, not passively. Skeptics initially questioned this method, but the results spoke for themselves. This approach turned out to be one of the most accessible, repeatable ways for regular investors to grow wealth. With discipline and consistency, anyone could potentially replicate this performance. While many chase high-risk stocks or volatile crypto assets in hopes of massive gains, this investor focused on simplicity. His core belief: consistent investing in high-quality, well-structured ETFs with natural selection mechanisms, which automatically remove underperformers and prioritize leaders, offers a far more reliable path to long-term wealth. The 5 ETFs that powered his portfolio. This investor built his strategy around 5 carefully selected ETFs, designed not only for growth but for sustainability. He rarely sells any of them, aiming instead for a buy-and-hold forever philosophy. The selection was based on 3 primary goals. Number 1, capture the long-term growth of U.S. and global markets. Number 2, earn passive returns with minimal effort. And number 3, create reliable income without selling core holdings. This blend of capital appreciation and cash flow became the backbone of what he named the High Five portfolio. Let's explore the 5 ETFs that made this possible. ETF number 1 is RSP, the S&P 500 Equal Weight ETF. RSP tracks the S&P 500 Equal Weight Index, where each of the 500 companies gets equal exposure, unlike traditional market cap-weighted indexes. Why it matters? It reflects the average performance of all companies, not just tech giants. The index is reviewed and rebalanced quarterly. Companies that fall behind are replaced, creating a self-cleaning, natural selection effect. RSP Snapshot. The issuer is Invesco. The expense ratio is 0.2%. Expense ratios means the yearly fee as a percentage that ETF or rate providers charge to manage your money. For example, a 0.2% expense ratio means you'll pay $20 a year for every $10,000 you invest. RSP's PE ratio is about 21. A PE ratio, or price-to-earnings ratio, tells you how much investors are willing to pay for $1 of a company's earnings. A high PE might mean a stock is more expensive compared to its earnings, and a lower one might mean it's cheaper. RSP's dividend yield is about 1.6%. The dividend yield is the percentage of your investment you get back each year as cash payouts or dividends. For example, a 4% dividend yield on a $10,000 investment equals $400 per year in payouts. RSP's 10-year CAGR is about 9%. 10-year CAGR, or compound annual growth rate, is the average yearly growth rate of your investment over 10 years, assuming the profits were reinvested every year. It smooths out the ups and downs and tells you how fast your investment has grown year by year on average. This ETF serves as the portfolio's core, tracking the general U.S. economic engine. ETF number 2 is IWY, the Russell Top 200 Growth ETF. IWY targets the 200 largest growth stocks in the U.S. across all exchanges, offering broad exposure to fast-growing industry leaders, particularly in technology. Why not QQQ or XLK instead? IWY offers broader sector inclusion than NASDAQ-focused QQQ or tech-only XLK. If tomorrow's growth rotates into financials or industrials, IWY is positioned to capture it, while QQQ and XLK might miss it. IWY Snapshot. The issuer is BlackRock. The expense ratio is 0.2%. The PE ratio is about 35. The dividend yield is 0.42%. Its holdings are 111 stocks heavily weighted toward top tech names. Its 10-year CAGR is about 9%. This ETF serves as the aggressive, growth-oriented component of the portfolio. ETF number 3 is MOAT, the Morningstar Wide Moat ETF. MOAT focuses on companies with durable competitive advantages, what Morningstar calls wide moats. These are firms positioned to thrive regardless of economic shifts. A wide moat is a long-lasting advantage that helps a company stay ahead of its competitors, like strong brand loyalty, patents, or cost advantages. Think of it like a castle surrounded by a deep moat. The wider the moat, the harder it is for rivals to attack or copy the business. Investor Warren Buffett often uses this term. He looks for companies with wide moats because they tend to be more profitable and more stable over time.
The most important thing what we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle.
Examples of wide moats: Apple's brand, Google's search dominance, or Coca-Cola's global distribution. Why include MOAT ETF? Its selection process filters for quality, ensuring only the strongest companies make the cut. Equal weighting across holdings avoids overexposure to any single name or sector. MOAT's snapshot. The issuer is VanEck. The expense ratio is 0.46%. The PE ratio is about 24. The dividend yield is about 1.35%, and its 10-year CAGR is about 12%. This ETF adds a layer of defense, investing in quality over hype. ETF number 4 is PFF, the Preferred Stock ETF. PFF holds a portfolio of preferred shares, mostly issued by large U.S. financial institutions. These hybrid securities behave like a mix between stocks and bonds. Why include preferreds? They pay fixed, often cumulative dividends. They offer higher yields than most bonds and provide regular cash flow without selling principal. PFF snapshot. Its issuer is BlackRock. The expense ratio is 0.46%. Its PE ratio is about 4, and its dividend yield is about 7% with monthly payouts. However, for this high-five ETF, our investor was lucky as he invested during the uptrend from August 2023 to August 2024, as PFF's 10-year CAGR comes in at a disappointing negative 2.5%. Ideally, for those seeking consistent income, PFF was to add a reliable income stream, but maybe this ETF could be replaced with a more suitable 10-year CAGR going forward. ETF number 5 is VNQ, the U.S. Rate ETF. VNQ offers exposure to income-producing real estate assets, apartment buildings, offices, industrial space, and more. Why include rates? Real estate adds diversification. Rates are legally required to distribute at least 90% of taxable income to shareholders. VNQ provides another layer of income, balancing out growth assets. VNQ snapshot. The issuer is Vanguard. Expense ratio is 0.13%. The PE ratio is about 33. The dividend yield is 4% plus, with quarterly payouts. The 10-year CAGR is about 1.3%. The assets under management are about $33 billion plus. Though sensitive to interest rates, rates offer long-term rental income potential. The strategy overview. The high-five portfolio was equally weighted among all 5 ETFs. Contributions were made monthly, dividends were reinvested, and the entire portfolio was rebalanced once per year. A hypothetical example. Start with $100,000, contribute $1,000 monthly, hold it long-term, and rebalance annually. Backtests showed this strategy consistently outperformed broader U.S. market indexes like VTI and even more diversified portfolios like Ray Dalio's all-weather portfolio. The bigger picture. With a disciplined 10% annual return, the investor calculated that a $500,000 base, compounded and supplemented with regular contributions, could grow to over $9 million in 30 years, all without needing to trade, chase trends, or time the market. Key habits. Rebalance once per year. What does rebalance once per year mean? Over time, some investments in your portfolio will grow faster than others and throw off your original balance. Rebalancing once a year means checking your portfolio and adjusting it back to your original plan. For example, if you started with 20% in each of 5 ETFs, but one grew to 30%, you would sell a bit of the overgrown one and buy more of the undergrown ones to return to 20% each. It helps keep your risk level steady and your strategy on track. Add $1,000 monthly. Increase contributions during downturns when possible, and let time and compounding do the heavy lifting. Overall, the investor's claim of $500,000 growing at 10% annually with $1,000 per month contributions could become $9 million in 30 years is mathematically accurate. Here's the caveat. 10% CAGR is not guaranteed. That's a historical U.S. equity market average, but markets go through long periods of underperformance. This portfolio includes rates and preferreds, VNQ and PFF, which might underperform during rate hikes or recessions. Rebalancing can help, but it doesn't magically boost returns. It mainly helps control risk by realigning your portfolio to your target allocation. This story isn't just about making money, it's about creating a simple, repeatable roadmap for anyone with patience, discipline, and a long-term mindset. Remember, investing involves risk, so do your own research and due diligence and proceed with caution before investing any money. If you want more videos like this one, don't forget to like, subscribe, and hit that bell. And tell me in the comments, are you buying any ETFs? Thanks for watching. See you next time.